Hey everyone, Akasha here, and okay, I need to tell you about something that happened to me last Tuesday that completely broke my brain. I was buying a new couch. Very exciting, very adult of me. And at checkout, the furniture website offered me a payment plan, a store credit card, and travel insurance, all without ever leaving the site, without ever interacting with a bank. I just sat there staring at my screen thinking, when did furniture stores become financial institutions? And that, my friends, is exactly what we're talking about today. Embedded finance. Money hidden everywhere. And trust me, once you see it, you cannot unsee it. So let's start with the basics because I know some of you are already Googling this while watching, and I love that about you. Embedded finance is simply the integration of financial services, things like payments, lending, insurance, investing, directly into non-financial platforms and apps. So instead of going to your bank to get a loan, the loan comes to you inside the app you're already using. Instead of calling an insurance company, insurance just appears as a checkbox at checkout. Now I spent years on Wall Street watching banks fiercely protect their territory. The idea that a mattress company or a ride-sharing app would one day be offering financial products would have sounded absolutely insane in 2005. But here we are. And the numbers are staggering. The embedded finance market was valued at around $65 billion in 2022. And analysts are projecting it to hit somewhere between $600 billion and $730 billion by 2030. That's not a typo. That is a 10 times growth trajectory in less than a decade. When I see numbers like that, I sit up straight and pay attention. Here's the thing people miss. This didn't happen overnight. The seeds were planted about 15 years ago with the rise of APIs, which are basically digital connectors that let different software systems talk to each other. Think of an API like a universal translator between apps. Companies like Stripe and Plaid came along and built the plumbing that made it possible for any app, your grocery delivery service, your fantasy football league, literally anyone, to plug into financial infrastructure without building a bank from scratch. Stripe alone, which processes hundreds of billions in payments annually, essentially handed a financial toolkit to every developer on the planet. And once that toolkit existed, the floodgates opened. Because here's what every tech company figured out real fast. The moment you add financial services, customer engagement skyrockets, and so does revenue per user. It's not about being a bank. It's about owning more of the customer relationship. Now here's where it gets interesting. Because you are already using embedded finance. You just might not have called it that. Let me walk you through some examples that will make you nod your head so hard. Shopify. Everyone thinks of Shopify as a platform for online stores. But Shopify Balance gives merchants a bank account. Shopify Capital has issued over $5 billion in loans to small businesses, and Shopify offers merchant cash advances based on sales data. That little Canadian e-commerce company is quietly one of the biggest small business lenders in North America. Wild, right? Then there's Uber. When Uber launched Uber Money and the Uber Pro debit card, they gave drivers instant access to their earnings and cash back on fuel purchases. Drivers were spending more time on the platform because their entire financial life was now tied to the app. That's not a coincidence. That's a strategy. And I cannot talk about this space without talking about buy now pay later. Companies like Klarna, Affirm, and Afterpay turned point-of-sale lending into a multi-billion-dollar industry. Affirm processed over $20 billion in gross merchandise volume in their fiscal year 2023. $20 billion in transactions, all embedded invisibly into checkout pages at Walmart, Amazon, and Peloton. The consumer never felt like they were taking out a loan. They just clicked pay in 4. Genius from a product perspective, complicated from a personal finance perspective, but we'll get to that. So payments and lending get most of the headlines, but embedded insurance and embedded investing are honestly the stories I find most fascinating right now because they're earlier stage and the disruption potential is enormous. Tesla, yes, the car company, launched Tesla Insurance in several U.S. states. And because Tesla vehicles are covered in sensors constantly collecting driving behavior data, Tesla can price insurance in real time based on how you actually drive. They're not guessing your risk profile from a questionnaire. They're watching you take that left turn too aggressively. Traditional insurers are genuinely nervous about this because they simply cannot compete on data depth. On the investing side, look at what's happening with apps like Acorns, which rounds up your everyday purchases and automatically invests the spare change. It's embedded investing at the most micro level, and they've accumulated over 10 million customers doing exactly that. Or look at how Fintech platforms like Robinhood and Cash App embedded fractional share investing directly into apps people were using for other purposes entirely. Okay, I want to take a second and talk about why companies are so obsessed with embedded finance from a pure business model perspective, because this is where my Wall Street brain really lights up. When a non-financial company embeds a financial product, they earn what's called interchange fees, interest income, insurance premiums, or referral fees. And because they already have the customer's attention and trust inside their app, the cost of acquiring that financial services customer is dramatically lower than what a traditional bank pays. Banks spend an average of $200 to $400 acquiring a new customer. A tech platform embedding finance into an existing user base? Their customer acquisition cost for that financial product is effectively near zero. The economics are just completely different. This is why Goldman Sachs partnered with Apple to create Apple Card and Apple Savings. Goldman recognized they couldn't win the distribution battle alone. Apple has the customer relationships. Goldman has the banking license and the balance sheet. Together they launched Apple Savings and attracted $10 billion in deposits within just 4 days of launch. 4 days. Traditional banks were watching that and sweating. Now, I would be doing you a disservice if I only gave you the shiny side of this story, because there are real risks here and I have opinions about them. Strong ones. When financial services become invisible and frictionless, people make financial decisions without fully engaging their brains. The whole point of friction in traditional banking, filling out a form, talking to a loan officer, waiting for approval, was that it gave you time to think. Embedded finance removes that pause. And for consumers who are already financially vulnerable, that can be genuinely dangerous. The CFPB has been increasingly vocal about regulating buy now pay later products precisely because millions of consumers were stacking multiple BNPL loans simultaneously without realizing the cumulative debt burden they were building. There's also a data privacy conversation that I think is severely underrated. When your grocery app, your rideshare app, and your couch buying app all have visibility into your financial behavior, the picture they collectively build of you is extraordinarily detailed. More detailed than your bank has, honestly. And the regulatory frameworks for how that data gets used are still catching up. So where does this all head? Because I know that's what you're really here for. My honest take, based on what I'm watching in the market, is that we're moving toward a world where your primary financial relationships won't be with banks at all. They'll be with platforms. Your paycheck might land in your employer's app. Your savings account might live inside your favorite retail ecosystem. Your insurance might be managed by your car. And your mortgage, this one's still a few years out, could eventually be embedded into real estate platforms. The banks that survive this aren't going to be the ones who fight it. They're going to be the ones who become invisible infrastructure, the licensed, regulated backbone that powers all of these experiences while the customer-facing brand belongs to someone else entirely. It's actually a fascinating identity crisis happening at the highest levels of traditional finance right now. Look, I started this video talking about a couch, and I ended up here, talking about the possible end of banking as we know it. That's embedded finance for you. It starts small and quietly, and then one day you realize it has restructured your entire relationship with money without you even noticing. I think it can be genuinely empowering for consumers and small businesses who have historically been underserved by traditional banks. But I also think we need to stay sharp, stay aware, and not let convenience become a reason to stop paying attention to our financial decisions. As always, I want you thinking critically, not just clicking through. Do your research, read the terms, and understand what you're signing up for even when the sign up takes 2 seconds. If you found this valuable, hit that subscribe button because I cover this stuff every single week and we are just getting started on the fintech revolution. And let me know what you think in the comments below.